Welcome to The Explainer. Today, we're decoding something that's absolutely massive in the crypto space right now, the launch of the CHIP token. It's the native asset for the USD.AI protocol. We're going to look at the legitimate, real-world technology that's actually driving all this hype, but honestly, more importantly, we're going to expose the highly dangerous trading environment that's surrounding it right now. So let's just get right into it. Okay, to really understand this hype, we have to look at this absolutely staggering number. When the CHIP token dropped, it established a market cap of roughly $200 million. But against that $200 million market cap, it generated a jaw-dropping $1.3 billion in 24-hour trading volume. I mean, while most top 100 crypto assets maintain a volume to market cap ratio somewhere between, 2 and 30%, CHIP hit 338%. That means its entire $200 million market cap changed hands more than 6 times on day one alone. That doesn't signal steady, organic accumulation, right? It signals an intense speculative frenzy that's just fueled by arbitrage bots, day traders, and pure momentum. Because we're covering a lot of ground today, here is our roadmap. We'll be looking at what is USD.AI, the explosive CHIP launch, beware market maker traps, the tokenomics supply danger, valuation and price predictions, and finally, the trading survival playbook. Let's start with Section 1, what is USD.AI? Financing the AI revolution. Beneath all that speculative froth we just talked about, there's actually serious real-world utility here. It's aiming to solve AI's biggest bottleneck, which is incredibly expensive GPU infrastructure. You see, AI hardware like GPUs depreciate super fast. We're talking roughly 20% a year. If an AI company goes to a traditional bank, it can take anywhere from 6 to 24 months just to underwrite and approve a loan. And by the time the cash actually arrives, the GPU is already halfway through its lifespan. USD.AI steps in and solves this by tokenizing physical GPU fleets as on-chain collateral. This liquid credit instrument provides AI companies with their funding in under a week. It is quite literally the Fannie Mae moment for AI computing. So how does the whole ecosystem actually work? Well, with a massive $1.5 billion loan pipeline already in place, and Anchorage Digital providing compliant custody, the protocol mints a synthetic stablecoin called USDI. And this is fully backed by PayPal's PYUSD. Then there's the yield-bearing counterpart, SUSDI, which currently offers a pretty solid 6.65% APY generated directly from those GPU borrowers. And finally, we have CHIP. CHIP holders actually control the governance, meaning they get to vote on critical parameters like collateral rules and interest rate tiers. Moving on to Section 2, the explosive CHIP launch, rocket fuel for retail FOMO. What is really fascinating here is how this launch was just perfectly engineered to trigger a massive speculative frenzy. The project had $225 million in executed loans before it even debuted, so the demand was already at a boiling point. But instead of a slow, careful rollout, no, CHIP launched simultaneously across major exchanges: Binance, Coinbase, OKX, Bybit, and Robinhood. That spread liquidity instantly. And on top of that, platforms were listing it with up to 3x leverage right out of the gate. This amplified the extreme volatility and created a highly leveraged, fragmented battlefield that felt like the pure Wild West. Naturally, it shot straight to #1 on CoinGecko. Now for Section 3, beware market maker traps, the dark side of the chart. If you're going to trade in a highly leveraged battlefield where the volume is over 3 times the market cap, you absolutely have to know who you're trading against. Let's define exactly what we're talking about here. Market makers and major whales, they routinely exploit news-driven pumps to lure retail buyers in, only to dump their positions the exact second the price peaks. A textbook example with CHIP was the announcement of the Binance HODLer Airdrop. The positive news was priced in almost instantly, which triggered a massive surge of excitement. But the whales? They pushed the price up on low volumes specifically to trap retail buyers, and then initiated a brutal sell-the-news reaction. Early investors took their profits, violently reversing the price downward and completely liquidating the longs. And then there's the stop hunt. This is a totally brutal, calculated tactic. First, market makers lure traders in with a slow, gradual price creep, to fake a sense of a safe range. Second, they initiate a sharp, sudden spike directly into obvious stop-loss clusters. These are usually sitting right below recent swing lows. Third, once those stops are triggered, it causes a huge cascade of automatic selling. The whales just swoop in, scoop up the discounted tokens, and collect the liquidity. If you don't realize these 3 steps are happening right behind the scenes, well, you become the prey. All right, Section 4, the tokenomics supply danger, the looming dilution overhang. Beyond all that daily manipulation, there is a serious structural danger baked right into the protocol itself, and that's massive dilution risk. CHIP has a total supply of 10 billion tokens, but right now, only 20% are circulating. That means a staggering 80% of the entire supply is currently locked up, and it's heavily allocated to early investors and the ecosystem. So all this wild price action we're seeing today, that is happening with only a tiny fraction of the total tokens actually available. Right now, we're in what analysts like to call a fractional supply safe zone because those locked tokens have a 12-month cliff. However, the true danger zone begins in April 2027. That is when those major early investor unlocks actually begin. Suddenly, the market is going to have to absorb massive, continuous selling pressure as those early backers inevitably start taking their profits. That brings us to Section 5, Valuation and Price Predictions, Finding the Floor. So where does the true value actually lie when you strip away the massive AI narrative premium the market is currently applying? Well, if we compare USD.AI to peers like Ondo and Maple Finance using total value locked or TVL multiples, analysts converge on a base fully diluted valuation of around $270 to $320 million. Just notice how Maple trades at a 0.147 ratio, while Ondo commands a 0.985 ratio. To reach a $300 million valuation, USD.AI requires a 0.67 ratio. And what's crazy is that this base estimate actually sits slightly below the original $300 million ICO price. That $300 million threshold is absolutely the ultimate battleground prediction right now. ICO participants basically break even at exactly $300 million. It's really testing whether the AI narrative premium, which is heavily fueled by things like that PayPal partnership, can actually outpace the heavy governance token discount, especially since CHIP currently has no confirmed fee distribution mechanism. So the big question is, will the hype lift it, or are the fundamentals going to drag it down? Finally, Section 6, the Trading Survival Playbook, Protecting Your Downside. Knowing all of this, how do you actually go about trading it safely? First, you've got to stick strictly to technical confirmations. Never, ever trust a breakout without high volume. If the price moves but the volume is low, it's almost certainly one of those market maker traps we talked about earlier. You need to utilize the volume-weighted average price, or VWAP, to confirm true trend strength. And always check your on-balance volume. It's crucial to ensure a move isn't totally fake. I mean, if the price is rising but your OBV is falling, just stay away. Furthermore, you really must employ strict risk management tactics here. Check on-chain data for whale flows onto the exchanges. You need to know if large holders are moving tokens in to dump them. Drop your stop losses a bit lower using the average true range to dodge those nasty stop hunts. Whatever you do, don't just put them at the most obvious support lines. And finally, strictly monitor the critical EMA 50 technical floor, which is currently sitting right around 0.067. If the price breaks below this level with volume, it spells absolute disaster, especially for anyone playing around with that 3x leverage. As we wrap up this explainer, I want to leave you with a final, provocative thought. The fundamentals of solving the AI GPU bottleneck are incredibly strong, but the trading environment? It is a literal minefield right now. So are the incredibly strong protocol fundamentals, the massive backing, and the real-world utility enough to survive this intense market manipulation and that looming token dilution? Keep your eyes on the data, always protect your downside, and keep asking the tough questions. Thanks so much for joining me on this explainer, and I will catch you in the next one.